In this video, we'll be talking about the different kinds of cash flows, starting out discussing the accounting cash flow statement and the change in cash in that statement. And then we'll work our way through 5 other kinds of cash flows, namely EBITDA, cash flow, free cash flow to equity, and then end up with free cash flow to the firm. This video is brought to you by PolarisInvesting.com, a site for creating defensible valuations. As a reminder, business valuation is based on expectations derived from skillful consideration of past facts and future possibilities. Well, let's get to what we will be talking about specifically in this video. So we're going to start off talking about the net income statement. Make sure that we're in sync with exactly what the net income statement is about. And then we're going to ask the question, what does net income really mean? And explore that a little bit and end up with the need for a cash flow statement. And so we'll review quickly the accounting cash flow statement, a little bit of the history of where it came from, and basically what an accounting cash flow statement shows. And we'll talk about the 2 different styles that there are of laying out a cash flow statement, either the direct or indirect cash flow statement. And then we'll talk about the details of the indirect cash flow statement. From there, we'll talk about free cash flow to the equity holder, free cash flow to the firm, trade-offs with those 2 different types of cash flows. And then we'll what you're looking at now is at the bottom here, EBITDA. We'll talk about that when we're talking about the income statement, but EBITDA, well, even the net change in cash flow that's shown in a cash flow statement, compare that to the EBITDA, what's called just general cash flow, free cash flow to equity, free cash flow to the firm. We'll compare all these and make sure, and we'll in fact go through this very infographic that's being shown currently here in the introduction. We'll go through and carefully explain how the different types of cash flows are derived from the income statement and the cash flow statement. And then we'll finish up talking about the Polaris valuation formula and relate its cash flow, the use of cash flows, particularly free cash flow to the equity holder, and how that gets mapped into the Polaris method of doing valuation. Now do a quick review of an income statement. At the top, sometimes referred to as top line, is sales, or sometimes referred to as revenue. Now some people would split hairs and say there is a difference between revenue and sales, and that revenue is the actual recognized dollar amount of goods sold, whereas sales is more representative of what the salesmen have actually sold, but maybe for various accounting reasons haven't recognized that total sales volume. But I'm going to go with this simplified and just say sales, meaning both sales and revenue, and might not make that fine distinction. From sales is subtracted off costs that can be directly attributed to the goods or services that were sold. This includes even fixed costs that can be properly allocated to individual goods. And then from that subtraction, you end up with a gross profit, and then a series of fixed or period costs are subtracted off. These are costs that cannot be associated with specific goods. And the big one being R&D, and a lot of the discussion in the accounting world about whether R&D should be written off like it is currently as a period cost, or whether it should be capitalized and then written off gradually over a period of time. But currently accounting rules require all R&D to be written off as a period cost. Then you have depreciation subtracted off, and from there you get earnings before interest and taxes. And if you add back the previous depreciation and then also amortization, you end up with a term called EBITDA. And EBITDA is an appropriate form of cash flow for high-tech companies that don't have a lot of capitalized tangible assets. Most of their assets are intangible R&D. So by the time you get down to that earnings before interest and taxes line in the income statement, you've got a fairly representative after investment type cash flow. Then you add back the depreciation and amortization, and you end up with a representation of the actual cash, because depreciation and amortization is not an actual cash expense. Well, anyway, after earnings before interest and taxes, you then subtract off the financing cost, which is debt times whatever the average interest rate is, R, that's being shown here. Add back any investment income that may be earned from non-operating type assets. So anything above the earnings before interest and taxes line is referred to as operating type expenses and revenue, and anything below EBIT is financing. And then you end up with earnings before taxes, subtract off taxes, get net income, and then management makes a decision on what amount to give back to stockholders as dividends, or they could even decide to spend some on stock repurchase, or just put it what's left over back into cash. But from an accounting standpoint, then you have an ending total at the bottom of the income statement after net income and dividends, which is just gets closed out to retained earnings. So when we get to the bottom and look at net income, which is also referred to as net profit, the question really comes into, well, what does that final number of net income really represent? Well, this question of what net income means is got quite a history, and there's an interesting story that about an iron company called Dallas out of England back in 1863, where there was a factory manager there that wrote to the owners of the company saying that even though we've had years of profit, an accounting profit, in this plant manager had been given the approval to expand production. The factory manager was surprised when discussing the project with the treasurer of the company that there was insufficient cash for the company to finance the investment themselves, and would have to seek outside financing. The owners had approved the expansion, thinking that recent profits were sufficient enough to build up cash reserves that would allow for the expansion. Well, this raised the question of what does net income really mean? And really what it boils down to is net income is an accounting business performance indicator that matches expenses with recognized revenue to come up with, again, a performance indicator. Cash, on the other hand, is measures the economic value of the business, and really at the end of the day, that's what's valuation is all about. A financial asset, stock, bond, bank deposits, etc., is intangible. The value is derived from a contractual claim and is equal to the present value of future expected cash flows. The stock market provides liquidity by enabling stock investors to realize the present value today. An important consideration about a company is what is the cash generated by the company year over year. To clearly see the distinction between cash flow and earnings, let's take a look here at a simple example. And the spreadsheet shows is essentially just think of an airline trip, a single airline trip, and we're going to assume that the main purpose of an airline is to move people. So we're going to measure the amount of operational work that's done by the number of miles that are covered. So we're going to take a typical trip that consists of a total of 1,825 miles, consists of 125 miles during the ascent or the climbing. We're going to cruise here for the next couple segments of the flight, and then eventually end up in a descent. During those different periods of the flight, we'll have different amount of fuel that's consumed, and other costs that we'll get into as we go through this example. Now, when we're all done, we're going to back up and say, okay, instead of just viewing this as a simple airline flight, let's think of it as a company that has similar kinds of expenses early on, middle of the road expenses, and then as they're wrapping up the project, similar kind of ending projects. Then we'll think of period as being not just segments of a flight, but maybe over a period of years. And then down here at the bottom, we're going to calculate present value of cash flows. All right, I want to back up here and point out that Alex Pollock made a comment, said, profit is an opinion, cash is a fact. And I want to have you keep that in mind as we're going through this example, that profit is an opinion, because things like what we'll show here, period costs, we're showing that in a particular period, let's say here, period 1 is $10,000 of costs. Well, or expenses, excuse me, that things are actually being expensed. Well, the plain portion of that total expense is primarily depreciation, and what type of depreciation, what kind of what assets to depreciate, how quickly, all those kind of things are somewhat opinion, or a decision is made by management as to which approach to take. So throughout any operation of a company, all kinds of accounting accrual type decisions are being made. So when you end up with a final earnings value for that specific period, it can't avoid being based on opinions or decisions made by the management team. So you see here, it says earnings is an opinion on period operational efficiency, which depends on how much work is recognized in that period. Again, we're using the number of miles traveled to reflect the amount of operational work that is done. There's no linkage between efficiency and effectiveness, particularly across periods. So earnings was designed based on the ongoing concern accounting philosophy, where the focus is on appearance of stability and continuity. Earnings are smoothed out in order to keep earnings in perspective from period to period. A company with a lot of upfront costs expenses those costs over many periods in which those costs generate revenue. The Financial Advisory Board, also known as FASB, felt recognizing costs as they occur as expenses misguides investors. A more balanced view of the company is to recognize costs as expenses in the periods from which revenue is generated from those costs. CPA stands for Certified Public Account, but for an investor, it may be better to think of it as continuity, perspective, and appearance. So earnings is a smoothing type number that reflects the efficiency of work performed in a period. Essentially, how well was the work accomplished, or put in accounting terms, how much revenue was generated compared to the expenses recognized. Earnings is a very specific statement about what was done in that period, as opposed to earnings in this period, earnings in the third period, and the fourth period. Cash flow, though, measures cross-period economic effectiveness. So we can see here that when we do a present value of cash flows, we can actually, assuming a weighted average cost of capital of 15%, this shows that in this first scenario, or what I'm calling scenario A, in the left portion of the spreadsheet, we actually have a positive present value, which says that this scenario that we're going to go into a little more detail results in a return of 19.2%, which exceeds the weighted average cost of capital. Therefore, you have a positive value add to the business by performing this flight. Now, this other scenario changes just one thing. It looks at the way that cash comes in, and we're assuming these are just assumptions of what percent of the total cash received, which is the same in both scenarios of $75,000. When do we expect cash to actually be received? Or when is cash received? So here we're assuming that 20% of that $75,000 is received in the first period, 20 in the second, 20 in the third, and the majority of it, 40% of it, is not received till the fourth or final stage of the flight. Scenario 2 says, well, what if we assume only 5% of the cash is received and then the majority of it, 55%, is received at the end, or stage 4. And we can see here, just by making that slight change in when cash is actually received, it results in a return of 11.9%, which is below the weighted average cost of capital of 15%, and therefore the present value of cash flows is now negative. So in this scenario B, you're actually destroying value, and therefore the project or the flight should not have even been taken on. Whereas in scenario A, you are adding to value, and therefore the flight should be taken on. All right, so let's look at where the big differences come in between cash flow and earnings. Well, the biggest one is how revenue is recognized or versus cash that's received. And again, we just went through what percent of the total cash and when it's being assumed to be received. But revenue is based on the work being done, which in this case is the number of miles traveled. So here's the total miles of the flight, and if we're assuming that it takes 125 miles to climb up, well, then that's only 7%. Therefore, we can only recognize 7% of the total revenue. Now down here in this section, we talk about the costs, and just talk about the number of gallons. You know, if you're in a typical project, you have more upfront costs, but in this example of an airline flight, you're climbing, therefore you're burning a lot of fuel, and then we're assuming a cost per up here of gallon of $1.25. Get a total fuel cost. This just shows you what it works out to in terms of fuel cost per mile. And so we end up with a total cost, fuel cost, that we occur in a specific period. And then we, just like in a real company, you have period expenses that cannot be directly associated with miles traveled or the unit of work that you're measuring. And so in this example, we're just saying, here we are at the beginning of a flight. You have gate personnel, plane prep, and really it really means plane depreciation that goes into that part of the flight. But anyway, we're assuming the total period expenses that have to be written off in that period is $10,000, and then you can see here that varies throughout this flight. So we end up with the total expenses of both variable expense based on fuel, and then these period expenses of varying from period to period. And those total expenses are the same regardless of which scenario we're looking at, because the scenarios only differ by when you assume cash is actually being received by the company. So when we come down and calculate earnings for each period, earnings is just simply revenue minus the expense. And you can see here that the earnings are exactly the same in both scenarios. Because of accrual accounting, it doesn't matter when cash is actually paid or received. It's all about when things are recognized in terms of revenue and expenses. But when we look at cash flows, they are quite different between the two scenarios because of when cash is received. Here, like in most projects, you have a negative cash flow at the beginning because you're getting started, but you can see here it's quite different than the earnings that are being reported for that first period. But it's not near as low as it is over here because we're assuming much less cash coming in this second scenario. The middle two periods are exactly the same in terms of earnings and cash flow. And then the last period, with majority of the in this scenario 2 being assumed cash coming in the last period, you have quite a bit of cash flow, whereas here in the first scenario, you only assume 40% is coming in, so the cash flow is different. Now we assume a weighted average cost of capital, and down here, instead of assuming we're talking about an airline, a single couple-hour air flight, we're now going to say, well, let's assume this is kind of a business. We're looking at a project that has similar characteristics in terms of expenses and such, and cash flow, that we're going to just assume this is now a 4-year period, and then use a weighted average cost of capital of 15%, and this is the discount factor we use year to year, and then you can see what the present value is when we multiply the cash flow times the discount factor, we end up with this number. We add it up, and you can see you get a positive present value. Whereas over here, just by that, again, a slight change of assuming the majority of the cash flow comes in at in the last period, we have a larger negative cash flow because we received a lot less cash in the first period. But here in the first period, a much larger loss, and because of the discounting, that factor doesn't really diminish the size of that number or size of this number much, and so it weighs heavily on the present value calculation. And then the middle two periods have the exact same calculation, and then a little bit bigger number over here for cash flow because it's at the end of the 4-year period, the discount factor is much bigger. And I'm sorry, we're talking about this number up here. 34,000 becomes this 19,000 in terms of present value. So this scenario B is impacted in two ways. That the negative cash flow weighs more heavily, but the positive cash flow weighs less heavily because it's coming in the last period. And that slight difference of just when cash is actually collected makes the difference between a project that is earning less than its weighted average cost of capital and therefore destroying value versus a scenario where a little bit more cash is collected up front, and now we have a return such that's above the weighted average cost of capital, and we're actually creating value. But the earnings is exactly the same between these two scenarios. So if you're evaluating two different companies that had the exact same flights between two cities and they operated apparently very similarly, but the only difference is in terms of their cash collection. That may not be obvious it won't be obvious if you're just looking at earnings. You'll say, hey, they're both earning the same amount. But in reality, company A is adding value and company B is destroying value and really shouldn't even be running the flight. This just shows the importance of taking a holistic view of the company. So this example hopefully clearly shows the distinction between cash flow and earnings. And it shows that forgetting that earnings is just an opinion about period operational efficiency and not actual cash, and how it can lead to some erroneous decisions. And this is the problem that got into this iron company got into, is that they got too focused on profit, and it assumed that profit would also mean that there was ample cash available. Well, this caused this factory manager to create what he called a comparison balance sheet, where he took the previous year's balance sheet with the most current year's balance sheet, did a difference of the different line items, and he was able to discover that it had a fairly significant buildup in inventory that caused the use of cash to finance or to pay for that increased inventory, and that left with little cash left over. So this really brought the need in for something beyond balance sheets, income statement, that something would reflect how the state of cash and what cash was used for, and what cash balance did you start out with, where did you end up with, and where did the money get used. So we fast forward here to at least from 1863 to 1973, and the FASB Accounting Standard Board did dictate in 1973 the requirement that every company must provide what they call the changes in financial position. Now, the problem with that statement is it didn't specifically say cash, and so some companies took liberty with that, and you didn't get consistency across companies as to what the changes in what financial position were they really measuring. So in 1987, FASB came out and mandated more specifically that every company must produce a cash flow statement in a specific style called the Indirect Method, which clearly shows the relationship between net income and cash flows. Now, it's interesting to note that later in 1994, the International Accounting Standards Board also started mandating cash flow statements from companies operating in countries throughout the world. Let's take a quick look at these two different styles or formats of the cash flow statement that FASB and IS board has mandated to be used. Actually, the indirect method style is the only one which is shown here on the right. But start off with the direct method that also is used by some. It is a more, as the name implies, a direct way to show the starting cash flows and then what the net change here is in cash flow. But there's some challenges with putting together this kind of a cash flow statement, in that particularly cash receipts from customers. Well, that can be a little bit involved to determine that from accounting type information involving having to go back to look at sales and beginning accounts receivable, ending account receivable. Some companies will even build into their accounting systems attributes associated with transactions, so it's clear as to whether transaction involved cash or not. So when it comes time to calculating this kind of a roll-up number, it's easier to calculate. So it is straightforward, showing the cash flow from operations, from customers, inventory, wages, such, and then cash flow from investing, and then end up with a net cash flow. But net income is an accounting concept. It's so important that it's the mandated style is called the indirect method. So even if companies do provide the direct method, they're obligated to also show the indirect method. It shows, the reconciliation of net income with cash, and so it can also be derived more straightforwardly from accounting information, and we'll be getting into that here shortly. Is how this indirect method is this format is, and the numbers that go into it are actually derived. But you can see here it starts off with net income, and then shows the kind of the taking the accrual counting out of net income, and then ending up with exactly how much change there was in cash flow. Let's now look into the details of the of how you pull the numbers for the indirect cash flow statement. And to show that, we're looking at here to the left a T account, or just a worksheet that just kind of like making notes of just a cash. And I want to stress that a cash flow statement is really anything that's expected to convert to cash within a year. So cash or cash equivalent statement. So when we say beginning cash, it's not just monetary savings account type cash. It's we're referring to cash that's both cash and cash equivalent. Is when again we want to stress that when we say beginning cash. So in this worksheet, I want to start off here at the top and just go back through the basic definition of accounting, where assets equal liabilities plus owner's equity. Well, assets also can be viewed as breaking up in between cash and non-cash, which equals liabilities plus owner's equity. Well, if we go further and now do some arithmetic, we can say, well, the change in cash equals the change in liabilities plus the change in owner's equity minus the change in non-cash assets. So you kind of starting to see why it's called the indirect method, because you're not explicitly listing the changes in cash flow. You're indirectly calculating the change in cash flow by what occurred to other accounts in the accounting system. Now, over here to the right shows a little more detail about the change in liabilities is actually equal to the change in account payables plus net new debt are the major two items that go into the change of liabilities. Change in owner equity is primarily net income minus dividends minus any net equity repurchase. So the net equity repurchase means both if you're issuing stock, repurchasing stock, it's the net repurchasing that's done. Now, the change in non-cash assets is change in depreciation minus property, plant, and equipment, or what's also known as this CapEx, minus inventory, minus accounts receivable. So the way this is laid out is that it breaks things up into sources and uses of cash, and then the three main sections that are here shown here vertically are operations, financing, and investing. So start off with beginning cash, and then here in operations you list the net income, which does come from assumed to come from primarily operations, and then you just list the sources based on this formula up here that like depreciation is considered to be an operating type cash flow that you add back in because it's not a real cash outflow. Accounts payable is essentially a loan from your suppliers, so it's viewed as a source of cash because you're not having to pay it. Accounts, here's just another accounts payable account to different suppliers. And then salaries payable. So if you're paying your employees every 2 weeks and we're looking at a cash flow in between those 2 weeks, you've got some outstanding salaries that you haven't paid yet, which is also, since you haven't paid it yet, is a source of cash. Then over here you have accounts receivable, which means that it's money that's due you, and therefore you're having to float those customers, and so it's a current use of cash. And then inventory obviously is if you've increased your inventory. Now down here at the bottom is showing the actual accounts for accounts receivable and such, and it's just showing the beginning and ending balance, and the amounts that are shown up here on the cash flow statement is really the difference between the balance sheet accounts receivable on the beginning balance sheet, and then the accounts receivable on the ending balance sheet of the period you're looking at. But then the difference there is what's being shown up here in the cash flow statement. Financing section, you have long-term bond issue, but you also have on the other side long-term bond redemption. So now this is showing that we've had $100,000 of a new issue, so that's a source. But if there had been some bonds redeemed or paid back, it would have been a use of cash. And then if there's any new equity being issued, it would be a source of cash. But the other side of that is if there was any repurchasing, it would be a use of cash. And then dividends, obviously, is a use of cash. And then here at the bottom you have CapEx, or property, plant, and equipment investing, which is definitely a use of cash. So again, the indirect method is that you're taking the basic accounting relationship of assets to liabilities and owner equity, doing some arithmetic, ending up with an equivalent statement for the change of cash, using that to then calculate the actual cash flows. Now note that the resulting change in cash number, in this case minus $25,000, can be referred to as a cash flow. But when you talk about cash flows, when we'll get into comparing the different cash flows, free cash flow, things like that later on. But you really need to qualify, particularly if you're talking to somebody, what do they mean by cash flow? And so we're seeing here a first representation of a cash flow, but in this case it's really just simply the change in cash coming from the cash flow statement. So that's all we're referring to here when we're referring to this specific cash flow. Now, one thing I want to point out is the going back to the format of the actual statement itself. You notice here that it does list sources and uses of cash, but inside the sources of cash it shows additions and subtractions for operations. This reflects changes in working capital that highlights the difference between net income and cash flow. So if we go back and look at the T account, What we're really doing with this part here is, even though it is a use of cash, it is shown as a subtraction from source in the indirect cash flow statement. And then when you look further at the statement, you'll see here that the uses of cash are primarily dealing with the financing and the investing piece of it. Let's start talking about the different terms and what they mean when people talk about cash flow. Well, here on the indirect method cash flow statement, there's a line item here that says cash provided by operations. In this case, it's showing $8,000. Well, that number is often referred to as cash flow, and it's intended to reflect the organic flow of cash. And organic means this from the operations of the company itself. It excludes any kind of external financing, debt, issuance of stock repurchase. It excludes any kind of capital investment. It just says, here's the cash flow that we've had organically from the company, and that's just again referred to simply as cash flow. Now, another one that we've already talked about is the this change in cash. And that's usually just referred to as change in cash, and that's referring to the ending cash change, and really nothing more than that. So change of cash, and then now we've seen cash flow and the distinction between those two. Another type of cash flow that's used in valuation is free cash flow, and it is this operational cash flow, then subtract off any required investment. And so again, that's supposed to be reflecting or more organically how much money that was generated by the operations of the company, how much was required for reinvestment, and then what's left over is referred to as free cash flow. So we've got three terms here now: change of cash, cash flow, and now free cash flow, when you subtract off required investment from the cash flow. All right, now a fourth one that we're talking about here is free cash flow to the equity holders, which is used in valuation. And you can see its relationship to here, the cash flow statement in accounting, in that it's, if you look through what free cash flow is defined to be, and then you can, and then just for completeness, this is also showing some approximations that you can make for free cash flow that I'm not going to get into now. But then a totally different way of looking at free cash flow is you can define it based on this change of cash, and you can say free cash flow, which is also called the potential dividend, is equal to the change in cash plus the dividends plus net equity. Now, this relationship right here can be proved algebraically by going back and looking at the definition here of what the change of cash is, and then the detail of the change of liabilities, owner equity, non-cash assets. And by plugging in all these values, you'll see the relationship between the change of cash and this definition, free cash flow, the difference being the dividends and the net equity. So really what you're doing here with free cash flow to the equity holders, which again is called a potential dividend, is you're saying it is the change of cash, but you add back dividends and you add back any net equity. So you're saying that before you distribute at all to the equity holders, which is primarily dividends and stock repurchase, you add that back in because these two values have been subtracted away from the change in cash. So by adding them back in, you then get back to kind of this, what you could potentially distribute to the equity holders, as opposed to what you management decided to actually distribute. Now, when you calculate free cash flow to the equity holder year by year, and in theory, all the way into the indefinitely into the future, and now you discount back those free cash flows at the cost of equity, you end up with the valuation of the company to equity holders, and then you divide by the number of shares outstanding, and that would give you valuation per per share. Now there is another form of free cash flow called free cash flow to the firm, and what it does, it's a little different. Instead of working off a net income, it's working off much higher, closer to the top of the income statement, namely off this area right here, which is also referred to as the operating income, or earnings before interest and taxes. And so instead of net income, it uses net operating income after taxes, which is also referred to as NOPLAT, which is net operating profit less adjusted taxes. Then plus depreciation, minus CapEx, minus inventory. So very similar thing. Now no debt, because again we're up higher in the income statement. We're talking about a cash flow now that is for all the financiers of the company, equity holders and debt holders. So up here, when you're dealing with free cash flow to the equity holder, debt is net debt is considered an inflow and beneficial to the equity holder. But down here, when you're talking about free cash flow at the firm level, you're higher up in the income statement, and therefore representing free cash flow this way. Now you can equate free cash flow to the firm to free cash flow to the equity holders just by realizing where you are in the income statement and work from the bottom of the income statement up. So going back there, you can see if you're at the bottom. Now you just, because you are after taxes, you just simply add back and subtract off these two items here after taxes and then you get an equivalent term. Now when you go about doing the valuation based on free cash flow to the firm, you can determine the free cash flow to the firm year by year, indefinitely into the future. Discounting back every one of those cash flows by the weighted average cost of capital. Why you use weighted average cost of capital and what that is beyond the scope of this presentation, but suffice to say there's sound theory behind that discount factor and the concept of free cash flow to the firm. The discounted yearly discounted free cash flow to the firm cash flows, discounted by the weighted average cost of capital, the present value of all that is referred to as the enterprise value. And the enterprise value can relate back to this equity value when you discount back the free cash flow to equity by the cost of equity, present value. And the relationship is that the enterprise value minus debt plus cash equals the equity value. Well, now that we see how free cash flow to the equity holder and free cash flow to the firm is derived and how eventually you use those flows and what discount factors to use to calculate valuation, you see that you can get the equity value from the enterprise value. So the question boils down to is which approach do you use? And so next I want to talk about some trade-offs associated with the different free cash flow versus to the equity holder versus free cash flow to the firm. Now here to the left, not going to go through it, but if you wanted to, you could freeze the video here and look into this more carefully. But this is just another representation of the free cash flow to the firm calculation and the free cash flow to the equity calculation, and this kind of shows you how they're derived a little bit differently from the available data. But here I want to focus on is the trade-offs. Well, when you talk about free cash flow to the equity holder, it's sometimes difficult because of the dynamic debt to equity ratio, and this causes the cost of equity to change. And so when you're trying to do present value, you really don't want to have a varying denominators. You're discounting back these different values, free cash flow values. Also, a dynamic debt ratio can cause interest and principal payments to vary considerably year to year, particularly if a company has a large debt to equity ratio. This results in lumpy yearly free cash flow to the equity holder, making forecasting cash flow growth more difficult. Free cash flow to the equity holder growth is a significant factor in calculating valuation. Smooth historical rate of change is preferable over wild yearly gyrations. Now I want to talk briefly about what we're talking about with this changing debt as you take on more debt. And it's referred to as the static theory of capital structure. And there's a lot behind this that deals with the Modigliani and Miller propositions that date back to the 1960s and that kind of thing. And so way beyond the scope of this video. Suffice to say that as a company takes on more and more debt, the cost of that debt increases, but also the cost of equity that becomes to the stockholders becomes a riskier and riskier company because of the higher and higher fixed costs represented by the interest payments that occur as the cost of debt goes up and up. So the average, or the weighted average cost of debt, which is this black line, will actually start to go up after a certain point, at about 50% debt ratio. So you'd have to have a company that is at a pretty high debt ratio. In fact, the debt ratio is, as long as it's below 50% debt to equity. But if you're looking at debt compared to debt plus equity, then as long as it's less than 33%, this is not a big issue. But some analysts prefer to use free cash flow to the firm because of these debt-related issues. Now, some difficulties about calculating free cash flow to the equity from free cash flow to the firm valuation is that, as we were showing earlier, that let's go back there and look at that real quick, that that if your goal is eventually to get to the equity value and you calculate the enterprise value, well, then you've got to come up with a value for debt and then add back the cash. You need to consider the impact of operating leases. Main advantage of an operating lease over debt is it transfers the maintenance of an item to the leaser. For technology items, it's a way to avoid obsolescence. Operating leases are contractual agreements that can result in loss of control of the items leased, thus are a form of debt. But unlike capital leases, operating leases are not shown as debt and asset on the balance sheet. To compute the full enterprise value, you need to convert operating leases to equivalent debt. Besides more debt, the conversion, also known as capitalization, creates an asset on the balance sheet. The increase in the enterprise value is accompanied by the same increase in debt, so the net impact to equity value is zero. Capitalization moves an operating expense to a finance expense. Since equity value is derived from net income, both operating and finance expenses are included. Capitalization of operating leases results in the same equity value as when operating leases are not capitalized. So capitalization of operating leases is really a moot point as far as equity value is concerned. A side note, as of 2019, the Accounting Financial Advisory Board started requiring all operating leases to be capitalized. This has a major impact on reported operating income for many types of industries, particularly retail, which leases the majority of its store space. This impacts debt ratios and financial metrics based on operating income. Now, when calculating the equity value from enterprise value, and then you also have to determine the market value of debt that you're going to be subtracting from free cash flow to the firm. And then the other thing you must have, because free cash flow to the firm includes it's after taxes, you have to determine the appropriate effective tax rate that you're going to use in your calculation. Another drawback is the need to calculate the weighted average cost of capital, which adds complexity. Here's the actual formula for the weighted average cost of capital. Not only does it include cost of equity, which you need to know for the free cash flow to equity approach, but you also have to have some idea of what your equity versus debt plus equity ratio is, and then also what the average cost of debt is. So not that it's that difficult, it's just that it adds yet more complexity than what you would have if you just had to determine the cost of equity. So both approaches have some trade-offs, but really as long as you're dealing with a company that has reasonable debt load, debt to equity less than 50% or debt to total investment less than 33% to equity holders is a reasonable approach. Well, now we've been through the different kinds of cash flows and how to calculate them. Let's go back and to the initial slide that was shown at the beginning of this presentation here and talk about the different cash flows and compare them. And what we'll do is be focusing down here. Well, we talked about EBITDA early in the presentation, and I guess as a quick refresher, go back and say, we're talking about here in the income statement where you're adding back depreciation. And if you recall, said if you're a high-tech company and doing most of your investment through R&D, which must be written off as a period cost, then EBITDA is a reasonable free cash flow to the firm. But for most companies, there are other required investment that must be included. So EBITDA is kind of a limited way to think about cash flow that only applies to a relatively small set of companies. Another here's the change in cash flow from the cash flow statement itself, and that's usually just referred to as change in cash. Again, we want to make sure that cash is not just savings account or money market cash, any asset that will be converted to cash within 1 year. Cash flow is cash flow from operations as shown in the change in cash flow statement. Cash flow is net income plus depreciation plus changes in working capital, namely accounts payable, accounts receivable, and inventory. Changes in working capital highlights the difference between net income and cash flow. Free cash flow is cash flow minus new investment, often referred to as CapEx, essentially property, plant, and equipment. Free cash flow to the equity holder is free cash flow plus net new debt. And then free cash flow to the firm, since it's dealing with higher up the income statement, namely net operating income, the data that it uses has to do with earnings before interest and taxes or operating income, subtracting debt, adding back depreciation and things that we talked about. There are a few other terms used when discussing cash flows that I want to briefly mention. First one is unlevered free cash flow, same thing as free cash flow to the firm. Second one is levered free cash flow, which is the same thing as free cash flow to the equity holders. And the third term is called distributable cash flow. It's a term popular in the transportation, sometimes called midstream portion of the oil industry. It is similar to free cash flow to equity, but only deducts maintenance or depreciated related CapEx. Thus does not include growth capital spending required for the net income reporting. The term distribution cash flow itself implies that it's the cash available for distribution, which it's not. So the term is pretty much meaningless. So there's different cash flows. Change of cash flow, EBITDA, cash flow, free cash flow to equity holder, and free cash flow to the firm. Now that we've got a good understanding of the different kinds of cash flows that there are, I want to talk about this last topic of this video. I want to talk about the cash flow that's used by the Polaris valuation formula, and assume that people have watched several videos out there on the Polaris Investing YouTube channel on the valuation formula. But as a reminder, this is the formula that's used by Polaris. And the second term of this formula has to do with the terminal value, and I've talked about that in plenty of other videos. But here in the first part is essentially the cash flow that's, again, this is the present value of this Y years. Polaris uses 5 years, so 5 times the current dividend, and then adds in this terminal value component. So I want to focus it on this first 5 years of cash flow. And on the surface it may say, well, dividends are somewhat arbitrary, so it seems odd that a valuation formula would be based on a dividend cash flow. Well, going to show here that the Polaris formula is actually equivalent to a free cash flow to equity. So let's back up here and go back to this view here, and I want to highlight this derivation of free cash flow to equity. Again, previously in the video we talked about how that is equivalent to what's shown above, but let's stress again what it is. It's the statement of a cash flow statement, change of cash, plus dividends, plus net equity repurchase is free cash flow to the equity holder. Well, if we can prove that the change of cash is included in that Polaris formula, along with the change of net equity stock repurchase is in the formula, and that what it leaves behind is just dividends, then we've proved that it is actually using free cash flow to the equity. So that's what we're going to do next. Let's focus in on this formula one more time. The free cash flow to the equity holder is sometimes referred to as potential dividend, but really a more appropriate description would say it's potential distribution. And the distribution back to a stockholder can occur three different ways. Dividends is the most well-known way. Stock repurchase is the second way that cash can be used to indirectly give it back to a stockholder by repurchasing other stockholders' stock, and essentially giving remaining stockholders a bigger share of the company. But there's also this third way that money is distributed to stockholders, and that's just parking it in cash and use it maybe for a later time. But the spirit of cash flow would say, as soon as that cash flow is realized, if it's not a dividend, if it's not repurchase, it's still a cash flow that's recognized in terms of a valuation calculation. So let's focus in on this this handling of change of cash in the valuation formula. There's two well-known ways to do it. One way is I'll refer to as the Damodaran approach, which is Dr. Damodaran from New York University. And then there's another approach that's used by McKinsey Consulting. Let's go back to the Dr. Damodaran approach first, which is really more in the spirit of true cash flow. It says that, like the formula we were just showing, that as the cash flow occurs in a year, you recognize it as cash flow to the equity holder, and that's what Dr. Damodaran recommends. So let's take a concrete example. Let's say there's $1,000 cash flow at the end of year one, and then it's not invested back in the company. It's just sitting on the books waiting to be invested in a project. Well, the following year, in year two, you've earned over that year, you've earned some interest I on the invested cash, but then you also decide, let's say that you're going to now invest it a year later in an equivalent capital project. Well, if you invested in it a year earlier, that the expected rate of return by a stockholder, cost of equity, which is being shown here as just R, would make that project now worth 1 plus R a year later. This captures the opportunity cost from delaying the project 1 year. So if you decide to delay the project, you would then invest minus $1,000 plus times 1 plus R. Well, if you look at the total value change to the corporation or to the company, you just take the present value of the cash flow in the first year, and then in the second year you are investing the money in a project that is now 1,000 times 1 plus R, and then over that year you've earned I on the $1,000. You discount it back, you do the arithmetic, and you end up with this expression for the total change in value that is realized by this scenario of delaying investment in a project by 1 year. Now the McKinsey approach says, let's treat change in cash is this simply an investment, a form of CapEx. Now it's non-operating, so typically you don't want to mix operating with non-operating, but you can say, hey, look, we're just going to treat it like just a CapEx investment. Now it's going to be suboptimal because you're earning just I on it instead of hopefully an overall cost of equity, at least R. So we look at the cash flow, the results from this way of handling it. Well, the first year there is no cash. You're just, it's reinvestment. It's subtracted off from the available cash flow. Then here in year 2, you still have zero CapEx, but you have earned I on the investment that you've made in a short-term money market. So it's not in a real project, but we're going to treat the money market as a suboptimal project. Well, we look at the cash flow, or the increase in value from this scenario. We got 0 in the first year. We get 1,000 I in the second year. And we do the math, and we see here that the present value, or the change in valuation, is exactly the same, no matter which way you think about how to handle this in your valuation formula. So either treat it as just another project and don't recognize the cash flow, or you do what Dr. Damodaran does and recognize the yearly cash flows. Now again, Damodaran's approach is more in the spirit of, recognizing cash flow. And cash flow really is from 3 different sources. It's dividends, stock repurchase, or just parking the cash on the books on behalf of the stockholder until it's needed at a later time. But as just shown, you can remove change of cash from cash flows by incorporating them in CapEx requirements. And now you're just left with dividends and net equity repurchase as your cash flow. Now, one last comment about this. If you use the Mckinsey approach, you're expecting that additional project of money market project will show up in earnings per share. So the Polaris approach uses in the terminal value calculation a growth estimate of sales times profit margin, which multiply those two together, you get earnings. This project of cash is reflected in the future profit margin, which when multiplied by sales growth is future earnings. Well, now let's turn our attention to stock repurchase. That's actually been discussed in other videos out there on the valuation playlists. And just as a reminder, where that shows up here is in future shares. So instead of incorporating it in the cash flows in the first 5 years, it's been moved to the terminal value term in the valuation formula. And again, other videos that go into that in quite some detail. But as a reminder of the justification for doing that, you can go out to July 2018 blog from Dr. Damodaran on his website called Musings on the Markets, and he talks about different ways to handle share count in a valuation calculation. And really the proper way to handle changing share count is to do nothing in your cash flow analysis, meaning that when a cash flow is in a particular year is negative, it's assumed that with discounting back at the cost of equity, and I'm not going to go through the whole blog, but he shows clearly that it's the same thing as issuing new shares. It's just you let the negative negative cash flow in that year kind of capture the fact that the new stock would be issued at that point. But another way to handle it that he discusses in his blog is change the number of shares outstanding to offset negative cash flows. Negative cash flows are then set to 0. Now, if Polaris used the Damodaran approach in handling change in cash, yearly cash flows would vary, and years with negative cash flow would be set to 0 to apply this alternate approach. But Polaris uses the equivalent Mckinsey approach to handle change in cash, resulting in yearly cash flows equal to the dividend. In the terminal value term of the Polaris valuation formula, Yearly changes in cash are reflected in the future profit margin, which when multiplied by sales growth is future earnings. And outstanding share growth offsets years of negative cash flows, net of the dividend. Namely here that we just captured here by having incremental shares. That now allows us to remove from consideration it just incorporates the change of cash in the future profit margin, which when multiplied by sales growth is future earnings. The formula used by Polaris is a free cash flow to the equity holder approach. Net equity repurchase, and now you're just left with dividends that need to be accounted for in the first 5 years, and then it takes net stock repurchase into account by a future share calculation. Wrap up here by going back to where we started from and briefly go over what we talked about. We spent a lot of time talking about the cash flow statement. It's the background of it in two different styles, the indirect format style and the direct format style. We also talked about the different types of cash flow, ranging from just change in cash that you see on the indirect cash flow statement, EBITDA, cash flow, free cash flow to the equity, and then free cash flow to the firm. Then we ended up talking about Polaris's valuation formula and the fact that it uses a form of free cash flow to equity, and it uses an approach for handling change in cash that comes from Mckinsey, and an approach discussed by Dr. Damodaran for handling net stock repurchase. All right, been a long video, covered a lot of ground, but hopefully you found it useful. Thanks for watching.